All right, tech investors, buckle up. Today, we're diving into a story that's got Wall Street buzzing. Ryan Cohen, the meme stock king and GameStop CEO, just dropped a cool $1 billion on Alibaba. Yeah, you heard that right. $1 billion. Is this the play of a visionary or a reckless roll of the dice? That's what we're going to unpack. Is Alibaba poised to become an AI powerhouse? Or is this investment a ticking time bomb in a market riddled with uncertainty? Stick around, because the answer might surprise you. Let's get straight to the news. According to the Wall Street Journal, Ryan Cohen, known for his involvement with GameStop and Chewy, has quietly amassed a $1 billion stake in Alibaba. This translates to roughly 7 million shares. This move comes as Alibaba is making significant strides in AI and cloud computing, and after the recent meeting between President Xi Jinping and prominent business leaders, boosting overall investor confidence. Cohen previously advocated for increased share buybacks, believing Alibaba's stock was undervalued. But the big question is, why now? And what does Cohen see that others might be missing? Okay, let's dissect this. Alibaba isn't just an e-commerce giant anymore. They're aggressively pivoting towards AI and cloud computing. CEO Eddie Wu has stated they plan to invest more in these areas over the next 3 years than they have in the past decade. This is huge. They're talking about leveraging AI to re-accelerate growth across their core businesses. We need to understand the nuances of Alibaba's AI strategy. They're focusing on developing large language models, LLMs, like Quinn, aiming to compete with the likes of DeepSeek and even global players. This isn't just about throwing money at AI. It's about building a competitive edge in a rapidly evolving landscape. Think about the potential applications: personalized recommendations, smarter logistics, and even revolutionizing their cloud services. This is where Cohen sees the potential for massive returns. One key area to watch is their distributed training infrastructure, which enables them to scale their AI models efficiently. This is crucial for handling the massive datasets required for training cutting-edge AI. Another area to watch is their work on federated learning, which allows them to train AI models on decentralized data sources without compromising user privacy. This is particularly important in China, where data privacy regulations are becoming increasingly stringent. Finally, their work on explainable AI is crucial for building trust and transparency in their AI systems. This is particularly important in regulated industries like finance and healthcare. A paper published in the Journal of Machine Learning Research by researchers at Alibaba, Federated Learning with Non-ID Data, JMLR 2021, highlights their advancements in this field. But remember, this is a long game. The AI landscape is constantly shifting, and competition is fierce. Now, let's talk about Ryan Cohen's track record. He's a brilliant investor, no doubt, but he's also known for his high-risk, high-reward plays. Remember Bed Bath & Beyond? He took a significant stake, pushed for changes, and then abruptly sold it, leading to the company's eventual bankruptcy. That's a cautionary tale. Some analysts argue that Cohen's investment in Alibaba is simply a bet on China's economic recovery and the potential for undervalued tech stocks. They see Alibaba as a sleeping giant, poised for a resurgence. The meeting between Xi Jinping and business leaders definitely adds fuel to that fire. It signals a potential easing of regulatory pressures and a renewed focus on supporting the private sector. However, others are more skeptical. They point to the ongoing geopolitical tensions between the US and China, the regulatory uncertainties in China, and the intense competition in the e-commerce and AI markets. They argue that Cohen is overestimating Alibaba's potential and underestimating the risks. They are saying that Alibaba is facing increased competition from companies like PDD Holdings and JD.com. Furthermore, the regulatory environment in China remains uncertain, and there is always the risk of further crackdowns on the tech sector. Let's be real. Investing in Chinese tech stocks comes with inherent risks that you just don't see in the US market. It's a different ballgame altogether. To truly assess the risk, we need to analyze Alibaba's debt-to-equity ratio, which indicates how much debt they're using to finance their assets. A high ratio could signal financial vulnerability. We also need to monitor the price-to-earnings, PE ratio of Alibaba compared to its competitors. A high PE ratio could indicate that the stock is overvalued. Finally, we need to track the volatility of Alibaba's stock price, which measures how much the price fluctuates over time. High volatility suggests a higher level of risk. By tracking these metrics, we can get a better understanding of the risk involved in investing in Alibaba. The market is split. It's a tug-of-war between optimism and caution. But here's a counterpoint to the skeptics. China's government is actively trying to stimulate its economy. The recent signals coming out of Beijing suggest a more supportive stance towards private enterprise. And Alibaba, With its massive infrastructure, vast user base, and now its aggressive push into AI, is uniquely positioned to capitalize on any economic rebound. Think about it. They control a huge chunk of the e-commerce market. They have a leading cloud computing platform, and they're investing heavily in cutting-edge AI technology. That's a powerful combination. Furthermore, Alibaba's international expansion is gaining momentum. Their international e-commerce business is growing rapidly, and they're expanding into new markets across Southeast Asia and Europe. This diversification reduces their reliance on the Chinese market and opens up new avenues for growth. Cohen might be betting that Alibaba can successfully navigate the geopolitical and regulatory challenges and emerge as a global AI leader. It's a bold bet, but it's not entirely without merit. We need to consider the potential upside. If Alibaba succeeds in its AI ambitions, the returns could be astronomical. But, and this is a big but, it all hinges on execution and the ability to adapt to a rapidly changing landscape. The key is to balance optimism with a healthy dose of realism. So, what does this mean for you, the investor? Well, first and foremost, do your own research. Don't just blindly follow Ryan Cohen's lead. Understand the risks involved, and only invest what you can afford to lose. If you're considering investing in Alibaba, diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different sectors and geographies to mitigate your risk. Consider using stop-loss orders to limit your potential losses. A stop-loss order automatically sells your shares if the price falls below a certain level. This can help you protect your capital in a volatile market. Follow reputable financial analysts and experts who cover Alibaba and the Chinese tech market. Stay informed about the latest developments and trends. Be prepared to adjust your investment strategy as the situation evolves. The market is constantly changing, and you need to be able to adapt quickly. If you are really bullish, consider using options to gain exposure to Alibaba's stock with less capital outlay. Just understand the risks of options before you trade them. Trading options can be very risky. Remember, investing is a marathon, not a sprint. Don't get caught up in the hype. Stay disciplined, stay informed, and make smart, calculated decisions. This is not investment advice. Always consult with a qualified financial advisor before making any investment decisions. Okay, let's wrap this up. Ryan Cohen's $1 billion bet on Alibaba is a fascinating story that highlights both the potential and the risks of investing in Chinese tech. It's a high-stakes gamble that could pay off big, but it's also fraught with uncertainty. The future of Alibaba hinges on its ability to execute its AI strategy, navigate the regulatory landscape, and compete effectively in a rapidly evolving market. So what do you think? Is Ryan Cohen a genius, or is he playing with fire? Let me know in the comments below. Are you bullish on Alibaba's AI potential, or are you concerned about the risks? I want to hear your thoughts. Also, don't forget to like and subscribe for more in-depth analysis of the latest tech trends and investment opportunities. And if you found this video helpful, share it with your friends. Thanks for watching, and I'll see you in the next one.